The stock market is open and we see Nvidia up around 2%, although we do see the oil and gas market taking a bit of a hit, down a few percentage points. Our focus today is going to be on PepsiCo that reported their earnings just before the market opened today. And when we do take a look, we can see some worrying features from this company. The first thing to point out is that they have trimmed their revenue outlook, and they've also reported revenue which was weaker than expected for the quarter. Not something we want to be seeing for Pepsi. Now, in terms of what the issues are with this company, their actual earnings, well, what we can in fact see here is that they've reduced their organic growth to a low single-digit increase. Bear in mind, just to keep up in line with inflation so that you are increasing in real terms, it needs to be 3 to 4%. So Pepsi believe that organic revenue will in fact be decreasing, and we can see prior they did believe it would have at least kept up in line with inflation at the 4% point. So a little bit worrying. However, what we can in fact see, they have reiterated their forecast for EPS to grow around 8%, which is nice to note. It is what we were expecting anyway, so not really any new information. We notice a marginal beat on the earnings per share, 231 versus 229, and as we can see here, even though it is a marginal miss, we do note revenue 23.32 coming in lower than the 23.76 of market expectations. In terms of the net income per share, well, 213 for this quarter. Worryingly though, we do notice from the same quarter last year, it was high at 224. So this hasn't been the greatest year for this company. And we do actually note when they do come to discuss some of the reasons why they are having troubles, they talk about weak demand in the North America for the overall volume, so customers are buying less. Reason for this? Well, they deem shoppers have been growing a lot more cautious, in fact eating, snacking less, as well as making fewer purchases at the convenience stores. Whether or not this is the real underlying issue, what we do note overall, Pepsi isn't particularly moving in the way we want. We want to see increasing sales, we want to see increasing volumes, and something we do need to consider in today's episode. Now, how has the market reacted? It was actually down a few percentage points. It is now up around 1%. Year to date, down 1%, massively lagging the S&P 500. Over the last 12 months, up although marginally at 4%. And if you've been a long-term shareholder, whilst you would be up 84%, as we can see and we will show you later on, you have underperformed the S&P over the same period. Now, currently it does sit in the mid to lower end of the 52-week range. It's currently around 10% shy from the 52-week high of $184. And we do note a double buy rating from Wall Street and Quant. We do in fact see Seeking Alpha currently give this company a hold. Nice to note though, for those that do like dividend yield, 3.24%, fairly attractive, and a forward P of 20.5, which is lower than the S&P, which sits around 24. Now, a very quick look at their quarter from their statement that they did also release. Their revenue for this quarter is down 0.6%. Earnings per share, as we will show you shortly, is also down, in fact, by around 5%. And when we do take a look at the foreign exchange impact, whilst it is that 2% point, overall, as we said, both top line and earnings per share not really growing, which is a little bit sad. This is what we ideally want to see as investors. And the one thing that really highlighted from their results, organic revenue growth at 1.3% is pretty much around the levels they expected for the full year, below the inflationary rate of 4%. So lots to consider in today's episode, and we do want to run through the actual underlying metrics of this company. Always good to see a very safe dividend score of 93. We did already talk attractive yield. We're going to discuss this undervaluation, and nice to report, at least in February this year, they did increase that dividend above inflation at 7.1%. Was reaffirmed back end of July, very safe score, which as we all know by now does indicate a dividend cut is highly unlikely. Now, last recession, 07-06, great recession, in fact, how they performed. They increased the dividend. They had above average growth, negative 0.5%, well above, in fact, the S&P's negative 12, and they also outperformed the S&P, negative 35%, S&P itself, negative 55. Nice to report consistently strong growth to that dividend year on year, and over the last 20 years, they have been increasing it by 11%. On top of that, they are a fairly new dividend king company, 51 years of consecutively increasing that dividend. Now, we do notice here this will show us undervaluation based on where this company sits in terms of the 5-year average PE. And when we do zoom over the last 12 months, pretty much every single month over the year, this company has been trading below its expected fair value, which is a good sign and does warrant further analysis of this company today. In terms of dividend yield theory, another model we do take a look at tells us a company is undervalued when the current yield sits above the 5-year average. So we have an undervaluation on the yield, undervaluation on the forward PE at 20.1, as it does sit below the 5-year rolling forward PE of 24.0. In terms of the sector PE comparison though, we do note consumer staples does sit marginally lower at 17.6, but as always, important to remember that we don't look at any one of these models in isolation. We will conclude when we do take a look at our own models shortly as well. Free cash flow payout then below 70% for consumer staples. We do notice it has gone above that, around 111% in 2022, 101 over the trailing 12 month, which indicates to us management paid out more in dividends than they generated in free cash flow. One of the reasons why we tend to ignore the earnings data, it is susceptible to manipulation by management through accounting, and as we can see, we wouldn't have spotted some of these issues. Positive to take though is over the next 12 months, it is anticipated pretty much to come in line with the maximum that we do want to see for the industry, but there are just some points here that you do need to think about. Free cash flow, as always, increasing over longer term. However, we do see very inconsistent, and what we do note over the next 12 months, it is anticipated to increase. So just have realistic expectations. PepsiCo is a company that, while will increase over the longer term, do expect fluctuations on a year-on-year basis. Sales growth 3 to 7% at a bare minimum. Remember, 3 to 4 just to keep up in line with inflation. Whilst we have seen that for the more recent period, we do notice both on the trailing 12 month as well as their recent earnings that this is something they have started to find a little bit more difficult. We already explained some of their reasons why they do believe this to be the case, but again, something we do ultimately need to factor in and can consider as part of our margin of safety. Total sales then, numerically, we can see whilst there has been growth of around 40% over the last 10 years, it hasn't been as much as maybe we would hope just to keep up in line with inflation every single year. They do some share buybacks, as we can see, reducing the share count on a year-on-year basis, but very inconsistent. In fact, 3 years, 2020 to 2022, where there was none. But again, bear in mind, this is always what we like to see as a bit of an added bonus to shareholders. ROIC, very important metric, 12% or more, incredibly consistent, so no worries whatsoever with this metric, which is very attractive for investors. Remember, we see 20% on a trailing 12 month. We want to see at a bare minimum 10 to 12% for this industry, just to give us faith management are able to effectively allocate their capital. Operating margin then above 16%. We see pretty much straddling year on year, but we don't get any operating efficiency, no increases to the margin over the longer term. Just something we need to accept with this company, given it is something they haven't been able to do over the last 10 years. And free cash flow margin, whilst it has been decreasing, nonetheless it is around that 7% level that we do like to see. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, below 4 every single year, which is great to note. 2.03 in 2023, in fact coming down from the COVID highs of 2.66, 1.9 over the next 12 months. So that is a good sign. Remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand, and given it does correlate to balance sheet strength and dividend safety, both of those do look to be strong for now, although we will shortly cover the balance sheet itself. As always, we do release a free weekly article every single Monday morning, so make sure you do click below, sign up, and you will receive your copy, as well as being able to have access to all of these articles where we talk about what's happened during the week and some undervalued stocks that we do believe deserve your attention. Also, to let you know, you can grab our 36 undervalued stocks for the month of October for your consideration, where we run through every single one, talk about which one sits within our own portfolio, and in fact, this month you can also grab 22 undervalued dividend stocks that Wall Street themselves believe have the most upside and do warrant some serious consideration. As always, click below on the pinned comment and you can read and sign up straight away. Other parts of our analysis include reviewing the inside ownership, 0.15% with around 9 million worth of sales over the last 12 months. But when we do take a look though, there has been no movement in quarter 4, again no movement in quarter 3, and around 1 million of sales in quarter 2, so not much to discuss. But as always, for that transparency, we will show you. In fact, the latest sale was by the CEO on the 9th of May, around 5,620 shares. In terms of institutional ownership, well, just over 73%, 16 billion worth of sales over the last year, 13 billion, so a little bit less during the same time period. And when we do look at Q3 and in fact Q2, we do see more buying than selling. So overall, institutions are selling more, but over the last 2 quarters, we see the opposite effect. And as always, do bear in mind to do your own research before executing and not copying any of these institutions. Now, in terms of revenue, we've already covered their growth, which hasn't been the greatest. At a bare minimum, we just want to see inflationary increases. For this part of the analysis, we want to highlight the bottom line net income, which from a graphical perspective, again, fairly inconsistent year on year. However, we do note around 50% growth from 6.5 billion in 2014 to 9.1 in 2023. In terms of the balance sheet for our quick health check, we already saw the net debt to EBITDA looking fairly attractive. 8.7 billion of cash in 2014, just under 7 billion in their latest quarterly report. And as we can see from that graphical perspective, it has started to come down from the highs in 2017. Now, when we take a look at this number, as always in isolation, it won't tell us anything. To the total debt numerically and directionally, we see it has pretty much increased significantly, 29 billion in 2014. And as we can see here, the growth year on year coming now to around 45 billion in the latest quarterly report. So again, something just to bear in mind, whilst their cash has started to pretty much flat or in fact decrease, their debt levels have been increasing. And whilst net debt does look okay for now, just something we should be considering about PepsiCo. In terms of their earnings moving forwards, well, nothing too glamorous, but as we can see, they are anticipating growth EPS year on year. Nice to note, over the last 4 quarters as well, they have outperformed analyst targets, and as we would expect, given their accuracy in their forecast, to hit that EPS of 8.69, the forward PE will come down to around 19.25. Now, in terms of some of the gradings and underlying metrics, well, D+ on valuation. In terms of the forward PE at around 21, whilst it is lower in fact than the 5-year rolling, it is still marginally higher than the sector as a whole, which as we can see here is up around 16.25, which means you are paying a premium right now for PepsiCo in comparison to the sector. And again, as we can see, that is the general theme right here today for whichever valuation metric you do use. In terms of the growth, nothing too great either at a C-. Revenue year-on-year growth 2%, sector median pretty much the same. Moving forwards around 4%, not far off the sector at 3.21. And we can also see over the next 3 to 5 years, EPS anticipated to grow 6.35 with the sector around 7.9. So not the most attractive grading so far, but one area where they do come through very nicely is profitability. A+ with the gross profit margin 55%, a lot better than the sector of 36%. Bottom line margin as well, 10.4, that is higher than the sector of 4.42, with a very strong and large number in terms of the cash from operations, 12.7 billion versus the sector of 739 million. Now, a quick recap for this part of the analysis: a hold from Seeking Alpha, double buy from Wall Street and Quant, D+ on valuation, C- on growth, with an A+ on profitability. Now, a few other things before we jump into our valuation. When we do compare this company against other similar like Coca-Cola, Keurig, Dr. Pepper, Monster Beverage, we can see over the last year, total return, now including reinvesting those dividends, it is in the middle point, up around 7%, which, let's be honest, is very, very poor over the last 12 months. When we expand this over the last 5 years, we get pretty much towards the bottom at 40%. Again, not the greatest in all honesty. And when we zoom out over the last 10 years, we can see up 145%, which may be okay to some investors. Others want a little bit more. But as always, important to remember that past performance does not give any indication to the future. And as we said, in comparison to the S&P 500, just over the last year, PepsiCo has lagged massively, up 7% versus the S&P's 35. Over the last 5 years, again, we can still say the same in terms of that massive difference between the two. And over the last 10 years, the S&P has significantly outperformed. Whether or not you believe PepsiCo can turn around their fortunes and outperform the S&P moving forwards, do bear in mind you could consider investing in a low-cost ETF that does track the S&P 500. Now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So how we got to our intrinsic value of $188, ran it through the 3 models. So we have the multiples valuation model, companies in a similar sector and size, average PE multiplied by the EPS of PEP, and we can in fact see a nice undervaluation signal for this first model today. But as always, we don't look at any of these in isolation. We then have the dividend discount model, average growth around 7.3%. We want it to be a little bit more conservative moving forwards at 5.25. We get our second undervaluation signal, quite a significant one indeed. We then move on to the DCF model, free cash flow year on year, average growth at 2%, and we have gone moving forwards around 10% in line with management targets. In terms of the discount rate, we then get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we actually get an overvaluation signal, as we can see here, 164, not too far off the market price of 168. So our intrinsic value today is purely the average of these three models. We also note it isn't too dissimilar from Wall Street's target of 187, where they do in fact see around 11% upside. We don't end there, as we always like to use a 10% margin of safety before executing, and that essentially we use if we believe the company has a wide moat, strong financial metrics, and good forward-looking data. Now, in today's episode for PepsiCo, we pretty much see it at that 10% level, but if you do want to see at a 15% point, a buy at 160, at 20% around 150, and at 25 around 141. However, in today's episode, just 10%, and remember you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for PepsiCo or any others. So 10% MOS, 11% upside, maybe not looking like the most attractive, especially with some of their metrics decreasing rather than increasing. The organic revenue growth is a little bit worrying, as we already said. That is in fact below what we would expect just to keep up in line with inflation, and their earnings have been decreasing in comparison to the previous year. As always though, do give us your thoughts in the comments below. Is this one you're looking to buy, maybe looking to hold, or in fact looking to sell for other stocks? If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Don't in fact forget to sign up to the free weekly newsletter below, where you can read all of the previous articles, and come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.